The price is moving fast, really fast. You've been watching this currency pair for the past hour and it's been relatively calm. But suddenly, out of nowhere, it explodes upward. A massive green candle, then another, then another. Your heart starts racing. You feel a surge of adrenaline. Your hands move toward your keyboard. Your brain is screaming one thing: get in now. You're missing it. Everyone else is making money right now except you. You know you shouldn't chase. You've read about it. You've been burned by it before. Your trading strategy has specific entry criteria, and this isn't one of them. You're supposed to wait for a pullback. You're supposed to wait for confirmation. You're supposed to follow your trading plan. But the price keeps climbing. Every second you wait, you're missing more profit. You imagine other traders riding this move, making thousands of dollars, while you sit here doing nothing. The feeling is unbearable. You can't stand watching opportunity slip away. So you do it. You click buy, right here, right now, at the worst possible price. You enter the trade with no plan, no stop loss, no real strategy. You're just chasing. You're just desperate not to miss out. And immediately after you enter, the price stops moving up. It pauses. Then it starts dropping. Your entry, which felt urgent just seconds ago, now looks like the absolute top. The move you were so desperate to catch is already over. Within minutes, you're down. The FOMO that made you enter is now replaced with panic. Should I exit? Should I hold? Why did I take this trade? You exit at a loss, frustrated and angry at yourself. You just chased a move and got burned. Again. But 5 minutes later, you see another currency pair starting to move. And that same feeling hits you again. This is the one. This is my chance to recover. I need to get in before I miss this too. And the cycle continues. This is FOMO trading. Fear of missing out. And it destroys more trading accounts than any other single psychological problem. It's not about bad strategy or poor analysis. It's pure trading psychology, the inability to sit still while opportunity seems to pass you by. Let me tell you about Yale, who lost $27,000 in 7 months to FOMO trading before he finally learned how to fix it. Yale had been trading for about 18 months when his FOMO problem reached crisis levels. It had always been there, lurking in the background, but it got progressively worse until it completely dominated his trading psychology. Yale's FOMO showed up in a specific pattern. He'd start each trading session calm and focused. He'd follow his trading strategy. He'd wait for valid setups. His first 1 or 2 trades of the day were usually disciplined and well executed. But then Yale would see a move happening somewhere, maybe in a pair he wasn't watching, maybe in crypto while he was trading Forex, maybe a stock that someone mentioned in a trading chat room, and that move would trigger his FOMO. Yale would abandon whatever he was doing and chase the move. He'd enter late at terrible prices with no real plan. These FOMO trades almost always lost money. But losing money on FOMO trades didn't stop Yale from making more FOMO trades. It actually made the problem worse. After 7 months of this pattern, Yale decided to audit his trading account. He went through every single trade and categorized them into 2 types: plan trades that followed his strategy and FOMO trades where he chased moves impulsively. The results were shocking. In 7 months, Yale had taken 203 total trades. 94 of them were planned trades following his strategy. 109 of them were FOMO trades, chasing moves. More than half of Yale's trades were FOMO trades. But here's where it gets really painful. The 94 planned trades made Yale $11,200. His trading strategy was profitable. His analysis was good. When Yale followed his plan, he made money. The 109 FOMO trades lost him $38,200. Yale's profitable trading strategy made him $11,200, but his FOMO trading lost him $38,200. The net result, Yale was down $27,000. His FOMO problem had completely destroyed his profitable trading strategy. Yale sat staring at these numbers, feeling sick. He wasn't a bad trader. His strategy worked. His problem was that FOMO made him abandon his strategy more often than he followed it. His trading psychology was sabotaging his trading ability. Yale's devastating discovery about his FOMO losses pushed him to understand the psychology behind this powerful force, and what he learned explained why FOMO is so difficult to resist in trading. FOMO isn't unique to trading. It's a universal human emotion that exists in all areas of life. Social media companies exploit it. Marketers use it. Your brain is wired to feel it. But in trading, FOMO becomes particularly dangerous because it directly conflicts with good trading practices. Here's the trading psychology of FOMO. Your brain is constantly scanning for opportunities and threats. When you see price moving fast, your brain interprets this as opportunity. Not just any opportunity, but opportunity that's escaping. Opportunity that's time-sensitive. Opportunity that will disappear if you don't act immediately. This triggers a primal response. For millions of years, humans who acted quickly when opportunities appeared had survival advantages. If you saw food and hesitated, someone else would take it. If you saw danger and hesitated, you'd become food yourself. Quick action was rewarded by evolution. But in trading, this evolutionary programming works against you. Fast price moves aren't opportunities escaping. They're often moves that have already happened. By the time you notice a move and feel FOMO, you're usually seeing the end of the move, not the beginning. Yale experienced this constantly. He'd notice a pair moving after it had already moved significantly. His FOMO would make him enter near the top or bottom of the move. He was buying high and selling low, driven by the fear of missing out on more movement that had often already occurred. The trading psychology of FOMO also involves what psychologists call social comparison. When Yale saw other traders posting about trades they were in, he'd feel FOMO intensely. They're making money right now and I'm not. I'm missing out. I need to catch up. This social comparison made Yale's FOMO worse because trading became competitive in his mind. It wasn't about executing his strategy anymore. It was about not being left behind by other traders. This competitive mindset destroyed Yale's discipline. Another aspect of FOMO psychology is loss aversion asymmetry. Leveraging a potential gain feels worse than taking an equivalent loss. Yale's brain would rather risk losing $500 trying to catch a move than miss a potential $500 gain by not chasing. This asymmetry meant that the pain of watching a move happen without participating was stronger than the pain of losing money on a FOMO trade. So Yale would repeatedly choose the action that felt less painful in the moment, but consistently lost more money. FOMO in trading also involves what psychologists call temporal discounting. Present opportunities feel more valuable than future opportunities, even when logically future opportunities are just as good or better. Yale would see a move happening now and feel compelled to chase it. His rational brain knew that another good setup would appear tomorrow or next week, but his emotional brain screamed, "This move is happening right now and you need to be in it." The present move felt infinitely more real and urgent than any future possibility. This made Yale abandon his trading plan in favor of immediate action, even when immediate action was clearly wrong. Yale's deep dive into FOMO psychology led him to categorize the different ways FOMO showed up in his trading, and he discovered that FOMO wasn't one problem, but 5 distinct patterns, each requiring different solutions. FOMO Type 1, the breakout chase. This is the most common FOMO pattern. Price breaks above a significant resistance level, it moves fast, you watch it climb, the FOMO hits. I need to get in before it goes even higher. You enter after the breakout has already moved 50 pips. Your entry is late. Often, the price reverses shortly after you enter because the breakout move is already exhausted. You entered at the worst possible moment. Yale tracked this pattern and found he made 47 breakout chase trades in 7 months. Only 8 of them were profitable. The rest caught the end of the move and reversed against him quickly. FOMO Type 2, the someone else is winning chase. You see someone in a trading chat post just entered EURUSD long looking great.
You weren't watching EURUSD, but now you quickly pull up the chart. You see it's already moved, but the person said they're in it and they're winning, so you feel like you should be in it too. You enter without analysis, without checking your trading strategy criteria, purely because someone else is apparently making money and you don't want to be left out. Yale made 28 of these social FOMO trades. 0. Absolutely 0 were profitable. By the time someone posts about a trade and you react, you're entering at the worst possible time. FOMO Type 3, the multi-market FOMO. You're trading Forex, following your Forex strategy, but then you glance at crypto and Bitcoin is pumping, or you see a stock moving. FOMO hits. The real opportunity is happening somewhere else. I'm trading the wrong market. You abandon your Forex positions or strategy and jump into crypto or stocks with no plan, no strategy for that market, just desperate not to miss the real opportunity. Yale made 19 of these cross-market FOMO trades. They were all disasters. He was chasing opportunity in markets where he didn't have an edge or strategy. FOMO Type 4, the recovery FOMO. You just took a losing trade. You're down money. Then you see a strong move starting somewhere. FOMO combines with desperation. This move could recover my loss. I need to get in now. You chase the move not because it's a good setup, but because you're desperate to recover your loss quickly. This combines FOMO with revenge trading, making it doubly dangerous. Yale made 11 of these recovery FOMO trades. All 11 lost money, making his drawdowns worse instead of recovering them. FOMO Type 5, the late session FOMO. It's near the end of your trading session. You haven't found many good setups today. You haven't made much money. Then a move starts. FOMO hits. This is my last chance today to make something. I can't end the session with no profit. You chase the move because it's your last chance, even though your trading plan might say the session is over or this isn't a valid setup. Yale made 4 of these late session FOMO trades. None were profitable. He was forcing opportunity instead of letting it come to him.
Yale's categorization of his FOMO types revealed something crucial. Certain trading behaviors and environments intensified his FOMO problem, and recognizing these amplifiers was key to controlling it. Amplifier 1. Watching multiple markets simultaneously. Yale would have 6 different charts open simultaneously. Forex pairs, crypto, maybe some stock indices. He thought this gave him more opportunities, but it actually fed his FOMO. With multiple markets open, there was always something moving somewhere. Yale's brain would constantly scan all the markets, looking for the biggest move, the fastest action. This constant stimulation kept his FOMO on high alert. Every time any market moved, Yale's FOMO would activate. Something's happening. Am I missing out? Should I be trading that instead of this? Amplifier 2. Being in trading chat rooms. Yale was active in several trading communities, Discord servers, Telegram groups, Twitter discussions. He thought this helped his trading by keeping him informed. But chat rooms amplified his FOMO dramatically. Every time someone posted, "just took XYZ long," or "this move is incredible," Yale's FOMO would spike. Even when he was in perfectly good trades following his own strategy, seeing others talk about different trades made him feel like he was missing out. The constant stream of other people's trades kept Yale in a perpetual state of FOMO. Amplifier 3. Checking price movement too frequently. Yale would check prices constantly, every few minutes, sometimes every few seconds. He thought he was being attentive and responsive, but constant price checking fed his FOMO. Every price update was a potential FOMO trigger. It's moving. Am I missing something? Should I be in this? The more frequently Yale checked prices, the more often he felt FOMO. Amplifier 4. Trading during high-impact news. Yale would intentionally trade during major news events because he thought that's when the big moves happened. And he was right, that is when big moves happened. But trading news events turned his FOMO into overdrive.
News events create fast, violent price movements. These rapid moves trigger FOMO more intensely than gradual moves. Yale would see prices jumping 50 pips in seconds during news, and his FOMO would become irresistible. Amplifier 5. Measuring success by daily profits. Yale tracked his profit and loss daily. At the end of each day, he'd calculate how much he made or lost. Days where he had made less than $300 felt like failures. This daily accounting fed his FOMO. On days where Yale hadn't made much money yet for the day, he'd feel pressure to catch a move before the day ended. That pressure created FOMO. He'd chase moves not because they were good setups, but because he needed to hit his daily target. Amplifier 6. Trading with insufficient capital. Yale was trading an account that was too small for his living expenses. He needed to make a certain amount monthly to pay bills. This created constant pressure that amplified his FOMO. When you need the trading profits, every potential move feels like something you can't afford to miss. Yale's financial pressure made his FOMO worse because missing opportunities felt like failing to meet his financial obligations. Understanding these 6 amplifiers helped Yale see that his FOMO problem wasn't just internal psychology. His external environment and circumstances were actively making it worse. After losing $27,000 to FOMO trading and understanding how his environment amplified the problem, Yale developed a comprehensive anti-FOMO system that transformed his trading psychology. Yale's system had 8 components, each targeting a different aspect of the FOMO problem. Component 1. Single market focus. Yale closed all his charts except for one market. He chose the market where his trading strategy worked best and committed to trading only that market. No glancing at crypto while trading Forex, no checking stocks, just one market. This single market focus eliminated 80% of Yale's FOMO triggers. There was no longer something else moving somewhere else because there was no somewhere else in Yale's trading environment. Component 2. Complete social media blackout during trading. Yale deleted all trading chat apps from his phone. He logged out of trading Twitter. He closed all Discord servers. During trading hours, Yale was completely isolated from other traders' activities. This eliminated social FOMO completely. Yale couldn't see what others were trading, winning, or posting about. This cut off a major FOMO trigger. Component 3. The entry criteria lock. Yale created a laminated card with his 3 entry criteria. Before taking any trade, he had to verify all 3 criteria were met by physically checking boxes with a dry erase marker. If all 3 were not met, he wasn't allowed to enter. No exceptions. No, but this looks like it might work anyway. The entry criteria lock removed the possibility of FOMO trades because FOMO trades never met all criteria. Component 4. The 10-minute rule. When Yale felt FOMO, when he saw a move and felt the urge to chase, he had to wait 10 minutes before making any trading decision. He'd set a timer. During those 10 minutes, he'd close the chart and do something else. After 10 minutes, Yale could reevaluate. Most FOMO urges passed within those 10 minutes. The urgent feeling that screamed "enter now" would fade. If the setup still looked good after 10 minutes, Yale would check his entry criteria. Usually, the FOMO had passed and Yale didn't take the trade. Component 5. The FOMO journal. Yale kept a separate journal specifically for FOMO urges. When he felt FOMO but didn't act on it, using the 10-minute rule, he'd write down what happened, what pair was moving, what made him feel FOMO, what would have happened if he'd chased. After a week, Yale would review this journal. He'd see that most FOMO urges involve moves that reversed shortly after. The journal provided evidence that resisting FOMO was correct, not a missed opportunity. This evidence countered his brain's tendency to remember only the times FOMO seemed justified and forget all the times resisting FOMO saved him money. Component 6. Weekly profit targets only. Yale stopped tracking daily profits. He set weekly targets instead. This removed the pressure to make something happen today that created late-session FOMO. On slow days, Yale could end with 0 trades and 0 profit without feeling like he failed. The week wasn't over. Opportunities would come. Component 7. The missed move mantra. Yale created a specific phrase he'd repeat when FOMO hit. Missing this move means nothing. Another setup will come. Missing this move means nothing. Another setup will come. This mantra provided an alternative narrative to the FOMO story. Instead of, "You're missing out, act now," Yale's brain heard, "Opportunities are abundant. You don't need this specific one." Component 8. Chart-checking schedule. Instead of constantly watching price, Yale checked charts every 30 minutes. He'd set an alarm. Only when the alarm rang would he look at price. The rest of the time, charts were minimized. This scheduled checking reduced FOMO triggers by 90%. Yale couldn't feel FOMO about moves he didn't see. By the time he checked charts again, moves had either completed or proper entry opportunities had appeared. Within 2 weeks of implementing this 8-component system, Yale's FOMO trading dropped from 109 trades in 7 months to just 3 FOMO trades in 2 weeks. Within 2 months, Yale went entire weeks without a single FOMO trade. His profitable trading strategy could finally work because he wasn't sabotaging it with constant FOMO chasing.
Yale's systematic elimination of FOMO didn't just stop him from chasing trades, it created a cascade of positive changes in his trading psychology and results that he never expected. Change 1. Dramatically better entry prices. Before fixing FOMO, Yale's average entry was terrible. He'd chase moves after they'd already moved significantly. His entries were at the worst prices. After fixing FOMO, Yale only entered at his planned entry criteria. His average entry quality improved dramatically. Better entries meant better risk-reward ratios, which meant better profitability even with the same win rate. Change 2. Massive reduction in trades. Before, Yale was taking 203 trades in 7 months, about 29 trades per month. After fixing FOMO, Yale took about 12 trades per month. This reduction might sound bad. Fewer trades means fewer opportunities, right? Wrong. Yale's fewer trades were all quality setups. His win rate jumped from 41%, when including FOMO trades, to 63%, trading only his planned setups. Change 3. Emotional stability. Before fixing FOMO, Yale's emotions were chaotic. Every move in any market triggered anxiety and urgency. Yale was constantly wound up, constantly stressed, constantly feeling like he was missing something. After fixing FOMO, Yale felt calm. With only one market to watch and checking it every 30 minutes instead of constantly, Yale's nervous system could relax. Trading stopped feeling like an emergency. Change 4. Account growth. The obvious benefit: Yale's account started growing consistently. In the 3 months before implementing his anti-FOMO system, Yale lost $11,400. In the 3 months after, he made $16,800. Same trading strategy, same market. The only difference was eliminating FOMO trades. Yale's profitable strategy could finally show its edge without FOMO sabotaging it. Change 5. Confidence in the process. Before, Yale's confidence was shaky. He knew his strategy should work, but his results didn't show it. This created doubt. After eliminating FOMO, Yale's results finally matched his strategy's expected performance. This gave him genuine confidence. Not false confidence or forced positivity, real confidence based on evidence that his process worked when he actually followed it. Change 6. Better life outside trading. Before, Yale's FOMO made him obsessively check markets constantly. Even outside trading hours, he'd check prices, check charts, check trading social media. Trading consumed his mental space 24/7. After implementing chart-checking schedules and social media blackouts, Yale had mental space for other things. He could enjoy dinner without checking crypto prices. He could sleep without market anxiety. Trading became one part of his life instead of consuming all of it.
Yale's journey from FOMO-dominated chaos to calm, profitable trading offers you a clear roadmap to fix your own FOMO problem starting immediately. Step 1. Audit your FOMO trades. Go through your last 50 trades. Categorize each as either planned trade following strategy or FOMO trade chasing a move. Calculate the profit and loss for each category separately. Most traders are shocked by this data. Their planned trades are profitable. Their FOMO trades destroy everything. Seeing this clearly is essential motivation. Step 2. Identify your FOMO type. Which of the 5 FOMO types do you experience most? Breakout chase, social FOMO, multi-market, recovery, late session? Understanding your specific FOMO pattern helps you design specific solutions. Step 3. Identify your FOMO amplifiers. Which of the 6 amplifiers make your FOMO worse? Multiple markets, chat rooms, constant price checking, news trading, daily profit pressure, insufficient capital? You need to know what's feeding your FOMO before you can cut off the food supply. Step 4. Implement single market focus. Tomorrow, trade only one market. Close all other charts. Remove temptation. Eliminate the something else is moving trigger that creates 80% of FOMO. Step 5. Social media blackout. During trading hours, log out of all trading social media. Delete trading chat apps from your phone. Create isolation. You can't feel social FOMO if you don't see what others are trading. Step 6. Create your entry criteria lock. Write down your 3 core entry criteria. Make a physical checklist. Before any trade, check all 3. If they're not all met, you don't enter. No exceptions. This eliminates FOMO trades because FOMO moves never meet proper entry criteria. Step 7. Implement the 10-minute rule. When FOMO hits, set a timer for 10 minutes. Close the chart. Do something else. After 10 minutes, reevaluate. Most FOMO will have passed. Step 8. Start your FOMO journal. Track every FOMO urge you resist. Write what happened. After a week, review the journal. See the evidence that resisting FOMO saves money, not costs opportunities. Step 9. Switch to weekly targets. Stop tracking daily profits. Set weekly targets. Remove the pressure that creates late session FOMO. Step 10. Schedule your chart checks. Don't watch charts constantly. Check every 30 minutes on a schedule. You can't feel FOMO about moves you don't see. The bottom line is, FOMO destroys trading accounts not because of bad strategy or poor analysis, but because it makes you abandon your strategy and chase moves at the worst possible times. It's pure trading psychology, the inability to sit still while opportunity seems to pass by. Yale lost $27,000 in 7 months because FOMO made him take 109 trades that completely destroyed the $11,200 profit his 94 planned trades made. His strategy was profitable. FOMO made him unprofitable. But FOMO is fixable. It's not a character flaw or permanent personality trait. It's a response to specific triggers and amplifiers. Remove the triggers, eliminate the amplifiers, and FOMO loses its power. Yale's FOMO trading dropped from 109 trades in 7 months to nearly 0 after implementing his 8-component anti-FOMO system. His account went from losing $11,400 in 3 months to making $16,800 in the next 3 months. Same trader, same strategy, same market. The only difference was eliminating FOMO. You can do the same. Audit your FOMO trades. Identify your FOMO patterns. Remove FOMO triggers from your environment. Implement the systems that prevent FOMO from controlling your trading decisions. FOMO will always try to chase. Your job is to design your trading environment so FOMO has no opportunity to turn urges into actions. Focus on one market. Eliminate social comparison. Use entry criteria locks. Implement the 10-minute rule. Build evidence that resisting FOMO works. Yale lost $27,000 learning this. You don't have to. Now you understand how FOMO destroys accounts and exactly how to fix it. The question is, will you implement the system? Will you audit your FOMO trades? Will you remove FOMO amplifiers from your environment? Will you commit to the anti-FOMO disciplines that transform chaotic chasing into calm, profitable trading? Your trading account depends on your answer. FOMO destroys accounts. Anti-FOMO systems build them. The choice is yours.